Recently, a new report of RBI has been released, and as per this report, a general trend is being observed where the consumers of India, we can say the bank customers of India, they are moving their money from the traditional saving accounts to the fixed deposit as such. So, what is the reason behind this trend? How banks can be impacted by this? And what is the basically what kind of message it sends us about the banking and financial system of country as well as economy of country? Let us try to understand this in more detail. Now, first of all, the report released by RBI, it is referred as annual basic statistical return on deposit report. It is released every year, and as per this particular report, RBI has stated that a major shift is being observed, and the shift is that people are now not so much interested in keeping their money in saving accounts. Rather, they are preferring term deposits. Term deposit, also called as fixed deposit. Difference is simple, as you understand. Saving bank account give you flexibility that you can use your money whenever you want without attracting any penalty or any kind of fee as such. So it gives you a more of liquid options as far as accessing your capital is concerned. Term deposit, as clear from the term itself, is basically for certain duration of time. It can be 1 year, 3 year, 5 years and such. And if you want to withdraw your money before the end of this term, bank generally charge you penalty with such. So that's what we have to understand, that depositors now are not worried about liquidity of money. Rather, they are attracted by the higher return rate. That means they want their money to work for them. They want their capital to also earn interest on them, and that's why they are shifting from saving to term deposit. Deposit profile of banks are undergoing a structural change. This is the reason why we are. This is the reason the change from saving account to term deposit, you can say, has led to the structural shift in the overall banks change, banks financial structure. Now, in the year 2022 to 2026, that's where a trend has been analyzed by RBI. So let us look at some of the important data to substantiate this claim. Now, if you look at the saving deposit share between March 2022 to March 2026, it has shrunk from 34.6% to 28.7%. That means in March 2022, almost 34.6% of banks deposit were in the saving account, and now it has been transferred. Almost 6% of the money has been transferred to the term deposit account. Term deposits here, similarly, we will see it is rising. Till 2022 March, it was just 55.2%, and in 2026 March, it has increased to 61.6%. So almost 6% decline in saving deposit and 6% of corresponding increase in the term deposit can be witnessed here. And the reason behind this is simple, because saving deposit today offers a very meager interest rate, we can say, on your capital, while term deposit offers a higher interest rate. Many times, inflation, if you count, saving deposit is giving you a negative rate compared to term deposits. So customers are willing to lock funds for better returns even when they are losing the flexibility to use their capital or money on a day-to-day basis. Now, why saving accounts lost appeal? So this has to do with the saving account interest rate itself. If you look at the SBI, that is the largest public sector bank of India, currently it offers an interest of 2.5%. That means if you deposit 100 rupees in your saving account today, at the end of year you will have 102.5 rupees as such. Now you compare it with the other private sector bank also, they have similar kind of pattern. HDFC, ICICI, all of them have 2.5% of interest rate. Saving rate used to be 6 to 7% almost a decade back, and that's why it was also attractive for customer to keep their money as they were earning handsome return. But now this is no longer the scenario. So we can see a massive decline we have seen in the rate of interest offered by saving accounts. Lower interest returns reduces attractiveness of saving bank account, because if you try to link it with the overall fixed deposit, same bank, if you see, for 1 year FD will earn 6.25%. That means roughly we can say somewhere 2.5 to 3 times more return you will earn if you keep your money in fixed deposit. Similarly, 2 year FD 6.45, HDFC 6.25. So there is a large gap between the interest rate offered by bank on the saving deposits as well as fixed deposit. Banks are using FDs to mobilize resources for credit growth, and that's why they also are giving handsome return here. And the reason is also to do with the purchasing power. If a person is keeping money in his or her saving bank account, he will earn just about 2.5%. Now compare this with the retail inflation. Retail inflation itself is 3.48%. That means if you use your cash, that will be better than keeping your money in the saving bank account. And that is because the saving bank account rate is much more lower, 1% less than the retail inflation itself. So the real return on saving are negative actually. Purchasing power declines over time. So if you have option of keeping 100 rupees in saving bank account and spending 100 rupees today, it will make sense for you to spend this money today rather than keeping an account, because you are earning a negative rate of interest. The value of your money is decreasing with the passage of time. So that is the reason why the customers and consumers are shifting toward higher yield instrument, which also provides a guarantee or safety. So out of all different modes of investment that you have today, instruments that you have today, definitely we can say the fixed deposit offers not only higher interest rate but also offers a degree of certainty, and degree of trust is higher in this case. Demand deposit, that is saving bank plus current account, stands somewhere about 31.65 lakh crore. Term deposit is almost we can say 7 to 8 times higher at 225 lakh crore. Current account earn no interest. That's why only businesses keep money in the current account. Term deposits dominate banking liabilities, and FDs are becoming preferred saving vehicles. And also the reason is because today you do not have to keep your money in term deposit or fixed deposit account for 3 years, 5 years. Even 1 year term deposit is something that banks offer. So people have certain amount of capital which they are willing to put for 1 year without touching it, and then at the end of year they will be getting handsome return. Household remains largest depositor. If you look at the entity contributing to this term deposits, household sector has 59.3% share in the term deposit. That means they are the largest contributor to banking deposits. Slight decline in share over recent year definitely we have seen, and the reason behind this also is because now people are more comfortable in diverting a part of their saving into the mutual funds and equities. Also the reason is because here interest rate or the return rate is quite higher. Mutual fund, most of mutual fund, we talk about even safest one, they have given a return of 13 to 50% on annualized basis in the recent year. In a long term, 10 to 12% of the decent return is expected from these equities. Definitely the risk is higher, but people are willing to spend some amount of their savings and term deposits in the equities for the higher return. Search for higher returns beyond traditional deposit is a growing trend in the Indian economy, in the Indian consumers. That is what we can see here. Now there is also a growing role of other sector. Non-financial sectors have made a contribution of 18.5%, which also has seen increase. Financial corporations share have increased by 1% also. An increased diversification of deposit base is being reported by the banks. They are saying that the household, non-financial sector, financial corporation, all of them are kind of increasing their share in the term deposit. Institutional deposits are gaining more and more importance, and now the bank have benefit because the base is diversified. They have less dependency on household alone as such. Now, if you look at the composition of FDs also, a clear trend is being witnessed where large value FDs dominate the entire deposit share. For example, the deposit which is of greater than 1 crore or equal to 1 crore makes up 46.3% of total term deposits. So understand, this is very important point to keep in mind, that high ticket or high value investors have more money in FD compared to low value investor, and that would make sense because people who are having less money, they want it to use on a day-to-day basis, and that's why they cannot put a large sum of money in term deposits. They prefer to keep it in the saving deposit itself. Now deposits of more than equal to 5 crore also has humongous share of 34.8%. That means we can say if you combine this deposit up to 5 lakh, if you talk about, it has 17.8% of share. So if you look at this and this figure, we can say that more than 60 to 65% of share of the term deposit or fixed deposit is of higher than 5 lakh value. High value deposits are increasingly important, and banks rely more on large ticket deposit as such. So that's preferred by bank. Preferred maturity profile, if you try to divide, we have seen that 1 year, 3 year, 5 year, 10 year. So 1 to 3 year deposits, their percentage has increased in last 4 years by almost 19%. So from 50% in 2022 to roughly 70% in 2026. Up to 1 year deposits, its share has dwindled, decreased from 16.7% to 8.8%. Now what does it tell you? It tells you that now consumers, bank customers are willing to put their money for a longer duration of time in the fixed deposit, either because they do not need it or because they want to reap a higher interest rate on a longer term deposits. Depositors locking fund for longer period, this is a general trend, because this value, if you look clearly, so we can definitely see that this value has definitely dwindled from 16.7% to 8.8% and such. And thus they are securing favorable interest rate. This is the reason behind such kind of composition. What is the interest rate profile of deposits? So deposit earning below 7%, their share has increased from 27.3% to 61.8%. So whenever we are talking about the shift of money from saving account to term account or fixed deposit account, it does not mean that rate of interest is very high. It is more than 2.5%, that's offered by saving account definitely, but also it is below 7%. So somewhere 6 to 6.5% we can say is where majority of term deposits are today are found. Reflects changing interest rate cycle. Repo rate also has reduced from 6.5% to 5.25%. That is also the reason. And deposit rates, that is why, has been repriced across the entire bank. If you look at the deposit growth and key takeaways, definitely the scheduled commercial bank deposit has grown. If you compare fiscal year 25-26 by almost 1%, 10.6% to 11.5%. Public sector bank here, they have seen highest deposit increment. 50.8% of incremental deposit has gone to the public sector bank, such as SBI, you have Punjab National Bank, Bank of Baroda and all. Private sector banks, they have seen incremental deposit of 38.6%. And interestingly, even in the rural areas, this trend can be observed, where the regional rural bank, their deposit share has decreased from 3.2% to 2.9%. So in rural areas, reverse kind of trend we are witnessing. Public sector bank, private sector bank, they are witnessing increase in the incremental deposit. But overall, if you look at the entire report, one thing is certain, that people are shifting from saving accounts to higher yield term deposits. That's a trend that cannot be muted, that cannot be falsified as such. So that's all about this particular video. I hope you got the idea behind the general trend in the pattern of shift from saving account to the term deposits and the reason behind this, driving factors behind. That's all for this video. Thank you.